Hello, and welcome to Idea to IPO. I'm Jason Putnam Gordon, and this is the latest investment and innovations in climate and energy tech. We've got a fantastic panel today with Carolin Funk, who's a partner at Blue Bear Capital. Madabushi, which I might have said incorrectly, so I apologize for that, who's the Director of Investment at National Grid Partners. Ray Abbiatici, who's an investment associate at BASF Venture Capital. Shaandiin Cedar, who's a senior associate at Powerhouse Ventures. And Chow, who's a principal at Clean Energy Ventures. You're going to hear more from them in a minute. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney at K&L Gates. I work with emerging growth companies in the climate and energy space and investors as they deploy capital into those entities. And K&L Gates is a global law firm with approximately 2,000 attorneys on 5 continents and 50 offices. That's full service and fully globally integrated. A few comments as to how today's event will run. So for about the first hour, there will be a panel discussion. The next 30 minutes after that will be Q&A. Please use the Q&A function if you've got questions. We will take questions at that point in time, questions of general applicability for those who are in the room. Today's discussion is not a confidential discussion. It's being recorded. So please don't provide any confidential information. Additionally, if you miss some or all of the recording, we'll follow up with an email afterwards and you'll be able to view it. And if you're only viewing it on the recording, well, we're glad to have you here too. With that in mind, I'm going to put one more plug to have everybody fill out the audience poll because we'd like to know who's here. And then I'm going to have each of the panelists go and tell you a little bit about themselves, their fund, sort of where they play in the life cycle of these companies and what types of companies they like to invest in. And maybe we'll start with Carolin Funk since she's been on the panel a number of times. She can set a good precedent. Welcome back, Carolin.
All right. Thanks, Jason, and thanks, Rob, to organize everything in the background here. Great to be back. Yeah, good to be here. I'm Carolin Funk, speaking to you from Berkeley, California. I'm a partner at Blue Bear Capital. Our focus at Blue Bear Capital is investing in the intersection of software, data, AI, and the energy transition. We invest in companies post-revenue. That's typically late C to Series A and sometimes early Series B with our first check. We're investing out of our third fund, and we really like to look at things that sit really deeply in the operations side of what we call climate tech or climate industry, or how we can define that later. Really anything that enables, accelerates, debottlenecks the energy transition is in scope for us. Before joining Blue Bear, I was on the operations side, head of operations COO at 2 different energy storage startups here in the Bay Area. And then even before that, spent some time in the corporate world at Siemens. And I'm originally from Berlin, Germany, where I started on the policy and consulting side, working with the German government and utilities on lots of fun stuff on energy transition, even back then.
Well, fantastic. We're delighted to have you back, Carolin. Raghu, why don't you tell us a little bit about yourself and your fund?
Yeah, sure. Raghu Madabushi. I'm with National Grid Partners, which is the CVC or the corporate venturing arm of National Grid, which is this big utility in the UK and in a few states in the US, Northeast. We have both renewable and more regulated utility portfolio. And we are mostly investing sort of Series A, Series B, but broadly in the energy transition, decarbonization theme. Anywhere that a utility can help accelerate that electrification of X, if you will. And we do take board positions. We do have a strategic mandate, but we are investing for financial returns. So most of our portfolio companies have the usual VCs on the cap table. I came here from Stanford's SRI Ventures, the Stanford Research Institute's SRI Ventures, and was at GE Ventures before that, and had a bunch of operating roles prior to that. Happy to be here.
We're delighted to have you. Ray, how about you tell us a little bit about yourself and BASF?
Sure. Thanks, Jason. So my name is Ray Abbiatici. I'm an investment associate with BASF Venture Capital. Much like Raghu with National Grid, we are the corporate venture arm of BASF, one of the world's largest chemicals producers based in Ludwigshafen, Germany. So I'm calling in from Los Angeles, but we've got a team that is fully global across Shanghai, Mumbai, Mannheim, Germany, 4 team members in North America, and Sao Paulo. We invest in seed to Series B companies that are helping to catalyze change for the chemical industry. So our key sector focuses are really pathways to industrial decarbonization, clean heat, clean energy, circularity of all things from textiles to battery materials to plastics all the way to mattresses, and agricultural products is a big business for BASF as well. And I think that last core area would really be battery materials. We're taking a close look at primarily EVs and other storage solutions. So before coming to BASF, I was working as an engineering consultant in New York on transportation and energy infrastructure, mostly transmission and distribution projects across the Northeastern Corridor. Came out to LA, where I started working on embodied carbon reduction strategy with the Structural Engineers Association of Southern California. So think clean concrete, clean steel, clean cement. And so now here just working on the broader industrial decarbonization strategy with BASF. So pleased to be here. Thanks, Jason.
Yep, wonderful to have you here. Let's see, Shaandiin, tell us a little bit about yourself and Powerhouse Ventures.
Yeah, great. Hi, everyone. My name is Shaandiin Cedar, and I am a senior associate here at Powerhouse Ventures. I am most recently coming from Greenpeace Group, headquartered in Oakland, where I worked in the corporate sustainability space. And my focus there was mostly working with corporate sustainability teams across energy, supply chain, built environment, mobility stuff. So corporate boardroom, goal setting, all of that kind of systems level thinking perspective. Before that, I actually I'm calling in from Denver, and I just moved back here, but worked here about 10 years ago in the built environment. So doing energy efficiency and renewable energy upgrades into multifamily. So really fell in love with this hairy idea of split incentive and how do we get technology into the hands of those who need it most. So there was a focus on low income housing there. So I think during that time, fell in love with this idea of climate justice, climate equity, and all of that. So try to embed that into my work as well. I'm also originally from Arizona and the Navajo Nation. So I've also been interested in kind of the climate tech innovation ecosystem and renewable energy development with tribes. So that's kind of a night and weekend kind of thing that I work on. So yeah, Powerhouse Ventures, we are early stage climate tech fund, very actually similar to Blue Bear, maybe a little bit earlier. So we invest in exclusively at the pre-seed and seed stage, software solutions, digital solutions for decarbonization. So our kind of core focus area has been historically energy and mobility and supply chain. So if anyone out there knows of good early founders in those spaces, feel free to send them over.
Will do. And we're delighted to have you among the other panelists. And Eugene, I don't think you've had an opportunity to tell us about Clean Energy Ventures or yourself yet.
Great, thank you. Well, thanks again for having me and Carolin for looping me into this panel. My name's Eugene. I'm a principal with Clean Energy Ventures, and I'm speaking from Seattle. Clean Energy Ventures is a climate-focused venture fund. So we invest in early-stage companies that are working on decarbonization and climate change mitigation. For us, the threshold that we use is 2.5 gigatons of greenhouse gas equivalent reduction between now and 2050. So it's a cumulative target, but that's the metric for us to decide whether or not we make an investment. And then once we decide whether it would fit our investment mandate, we have a financially based return mandate as well. That mandate typically means that we are investing in a lot of hardware or hard tech oriented companies, as I think a lot of the technologies that we need to decarbonize the economy are still needing to be developed on the hard tech or the hardware side. We now have 26 actually, as of yesterday, portfolio companies in that we're working with. So it's an exciting time. And our colleagues are based across the US, and we just had a colleague that started in London last week as well. So it's been a very busy week with Clean Energy Ventures. We invest in North American companies, also in European and Israeli companies too. As for myself and my background, I joined Clean Energy Ventures about 2 years ago, previously having worked with the corporate venture team of E.ON, the German utility. So lots of parallels here, I think, across the panelists. And then before that, started working in clean tech startups in the UK and the US, working especially on the energy and clean energy residential side. I didn't realize actually, Shaandiin, that you also started your career working in energy efficiency for multifamily homes. I also started my career working in energy efficiency for multifamily homes and commercial buildings in New York City, and have spent over 10 years now within the clean energy and climate space. So it's a pleasure to meet you all. Great to be here.
Well, we're thrilled to have you here as well. In terms of who's in the audience today, we've got, in terms of geography, almost 50% are from the Bay Area, 10% are from the US, 10% are from somewhere else in North America, 15% roughly from Europe, almost 10% from Africa, and then 5% from somewhere else. And then, as I mentioned before, this event is recorded, and so it may very well be that folks in other geographies are going to watch us on a time-shifted basis, and we're glad to have you here. As is pretty common, we've got first-time entrepreneurs make up nearly the majority of the attendees, with nearly 50%, 16% serial entrepreneurs, a blend of folks in small and growth stage companies at 5% each. 5% venture investors, some folks in academia and government, and then some others. Two other points of comment before I open up the panel discussion. One, I'm running all the tech in the background, so if anyone either on the panel or anyone in the audience sort of sees me looking away or looking at something else, I'm probably just task overloaded. It's not that the panel is not interesting. I think the panel is very interesting, but I want to make sure that everyone gets to have a good experience. Two, the chat is open for the audience. We ask, obviously, that you have respectful and constructive conversations in there. If you're going to have a side conversation, I will not be monitoring the chat, in part because I've got sort of enough other things going on. But I will be checking out the Q&A, trying to think about which questions we can take on later. With that, let's get going. So let's just maybe start. Here we are in Q2 of 2024. I think we can do a bit of an assessment of the broad sort of venture capital market overall in the last almost 20 months, let's say, has been down substantially. Looking at some of the data from PitchBook, let's say, climate tech investment was, I think, $41.1 billion last year, which is down, roughly 14% from 2020, from the prior year. But what are you all seeing? Like, what are the trends in the market that you're sort of seeing day to day, kind of recently? And then it feels to me like there's a little bit of a shift in momentum. Maybe we'll start with, I see Eugene is shaking her head. Maybe we can start with her.
Sure. So certainly agree. I think there has been a shift in momentum. I think unsurprising to everyone here, I would say that 2023 in particular marked a significant slowdown in venture capital investments in climate tech, but I think it was also venture capital and general investments across the economy. And I think it's a driver of many factors, not least of all interest rates going up and the general slowdown in the macroeconomic environment. I think since the year has begun, and speaking to a lot of my fellow colleagues in VC and in climate tech, I think the momentum has picked up since January this year. It seems as though everyone has their hands full working on deal flow and making deals and investing in opportunities. And I think part of that is reflecting some degree of optimism about the impending interest rate decreases, but then also I think the continued momentum around climate tech, and especially the support from the government around things like the IRA and grant funding and announcements that continue really strong. No doubt, I think, given the political landscape, there will be greater uncertainty, especially going on to the end of next year. But I think so far what we've seen is, especially given the funding commitments and the engagements from the government thus far, there's still been a lot of support for climate tech startups.
Other
Maybe
panelists,
to add,
yeah, jump right in.
I want to add to that just a plug for a friendly resource that I think we're all looking at and reading. I'm going to post a link here to the CTVC folks, Sideline Planet, who does great reporting and a really good newsletters. If you want to stay up to date, I think that's always a good resource in addition to the pitch books of the world and such. And well, what they've been tracking is that Q1 is already getting really, really hot in the space, especially new funds raising money in the space. They're tracking the dry powder in the space, and all of this looks really promising. So if you're out there looking to start a new company in the climate space, I think it's a really good time now. I think we've all seen a lot of activity, especially in the early stage, where it's still been a little harder if you're kind of at the Series B and C stage and beyond, and the exit path maybe a little more bumpy, but I think Shaandiin is nodding. The pre-seed, seed areas are really busy, and honestly, I've seen some really surprisingly high valuations already this year.
Yeah, echo what everyone else has been saying. I think because we do sit so early, Powerhouse Ventures is often looked at as a funnel to a lot of the other later stage climate tech fund, which we love being in that position. And just for maybe some data points there, January, February, March were record deal flow numbers in our terms. We've never talked and reviewed to more startups than we did in this first quarter. So just in compared to last year and in previous quarters, very much feeling a ramp up, at least in the folks coming back to market or starting new companies, or folks kind of having that pulse on the VC landscape and coming back into market. So just a quick data point there. But I will say the flip side of that is I think investor diligence bars was risen last year. Like bars were kind of increased, and I think that still is the case. So for our portfolio companies who are raising Series A and beyond, it still has felt slow and slocky. And at some point, we talk about all of this dry powder. At some point, I feel like it's an investor issue. Like we just need to deploy and just know that we all need to be bold on deploying this capital. So some data points on the early stage pipeline.
Yeah. Shaandiin, I think you raised a really good point about this bottleneck that sort of built up last year, because it was really hard to raise around in 2023. And so now a lot of funds need to devote a lot of attention to their portfolio companies that may have been planning to raise, but were not able to. So I think this is a sort of unplugging of the drain that we're going to see, where now that there are a lot of new funds that are active, those companies that have been trying to raise and failed are now going to be able to raise those rounds, and it's going to open up a lot more space for new companies coming in. So I do think there's a little bit of time for existing portfolio company management that a lot of VCs are still dealing with. But on the other side of that, I think we'll see a lot of new investment.
So from this, I sort of get the impression one of the theses here is perhaps, 2021, 2022 were sort of record years for raising funds. And maybe there's a little bit more pressure at this point to deploy some capital, or not necessarily pressure, but you say readiness to access and deploy the capital. Is that sort of what the consensus is here? And then are there other sort of maybe macro factors that might be driving this, whether it's sort of the Inflation Reduction Act, we referenced that earlier as the IRA, whether or not that's sort of kind of working its way finally through and getting processed, or is it the specter perhaps of interest rates maybe starting to come down? I'm just curious as to what might be sort of driving this, hopefully, change in trend for the better.
I can maybe add a little bit color on the macro side. See, half our portfolio, or at least some part of our portfolio, is based in Europe, and just the energy becoming, just the geopolitics of energy itself becoming an imperative has accelerated a bunch of things that weren't quite as important, say, let's in the last forcing function in the last year or two. So even if overall things have slowed down within clean tech and within certain geographies and within certain technologies, things have accelerated much more. So offshore wind in certain Nordic regions, electrification is still keeping up pace. Broadly, the overlap of defense tech with clean tech is, or energy transition rather, is still something that people are actively investing.
I think one really interesting macro trend is that we're seeing these big investment funds, like the Temaseks and TPGs and folks who are like multi-billion-dollar fund deployment are really looking for these bigger projects to roll out faster. And I think we have a little bit of a funnel mismatch still. It's like we have the early stage, and then we have, I think we can talk about this a little later, the valley of death in the or the valley of death in the climate sector. It might be like longer than in other sectors. Like you have to get through it to really get to scale. So I feel like there's a pull from the very large funds, and there's a push from the very early stage, and in the middle, folks are trying to figure out things. So I think one conclusion from that is what we're seeing in the market, that folks really looking at investing into, like, how can we figure out combinations of stories that then are kind of the 1 + 1 = 3. So roll-up strategies, kind of PE buyout strategies. There's a lot of circling around different portions of the industry, and I think that companies that are prepared for that and are actively preparing and actively kind of thinking about how they can benefit from the situation will have very, very interesting 2024.
I think you raise a really good point about the valley of death there, Carolin. For me, I think that's the most critical issue facing the industry right now, is how do we bridge that funding gap? And I think there is some really interesting work being done. For one, the Department of Energy has a lot of funding that's starting to come out for first-of-a-kind facility project finance. And there are a few funds that are actually starting to stand up first-of-a-kind specific funding vehicles. So I know Deep Science Ventures is one. There are a few private equity shops within the West Coast area that are starting to do specific project finance for early venture stage companies. with de-risk technology. So I think starting to see these sort of mid-sized vehicles that are willing to take on a bit more risk will really help these technologies reach scale over the next few years. And that's a space to watch for me.
I think one interesting factor in here, and we've got a great blend of folks who are on sort of more traditional funds and folks who are more on the corporate venture capital side, is sort of in the last few years, the deployment of by non-traditional investors, which include, either crossover funds and or corporate CVCs basically. And I mean, it's sort of one thing that I've noted anecdotally is it seems like, well, maybe there's been some pullback on the later stage companies because the exit was a little bit less certain. But there seemed to have been more activity an earlier stage, and certainly even in this panel, I think it's sort of somewhat reflective. I'd love to hear about how you've seen that trend over the last few years and where it might be headed. Eugene?
Yeah,
Abbiatici.
I think that's certainly true. Sorry, I saw Caroline, you came off mute as well, so I didn't want to jump in. But I think that's certainly true, but I think that ties a lot back to, the interest rate environment and the broader macroeconomic trends that we've been witnessing. And again, I think not unique for climate tech, but just because if you're a Series B, Series C stage fund, you need to be looking more closely towards exit opportunities. And I think all signs indicate that the IPO markets and certainly the SPAC markets aren't opening up in the near term, at least from what we can see. So I think that's a real challenge, especially if you're investing at the later stage. Hopefully that shifts and we have capital flowing a bit more freely again. But I think certainly if you're a seed stage investor or a pre-seed stage investor, you have a much longer time horizon and able to to look at companies that are looking to exit maybe in 5, 6, 7, 8 years time. I think what we have started to talk about already in this panel is around the first of a kind financing and all of the challenges that I think are uniquely challenging for certain segments of climate tech investments. So I think within this group, we have a good split of investors between software oriented versus hardware, hard tech oriented funds. And I think the profile for what that looks like across the board varies a lot. So, certainly happy to speak more about that. But, we do see infrastructure funds coming into the space and being willing to invest, but being forced, as Caroline was saying, to invest earlier stage. And I think that is throwing off the typical dynamic somewhat.
And I think what we've been seeing happening across our portfolio and also new companies we speak with is that people are just more frugal and think about how to spend money in more dedicated ways. So yeah, we've seen some rifts and layoffs, and I think following the kind of 2020 to 2022 kind of growth at all costs type investments were more to what are actually kind of bottom line needs and where do startups need to invest to also time their kind of product to market rights with growing their sales team. And I feel like there's been some portion over the last years where we've seen that maybe there were kind of initial steps made in the commercial side of the business where the product might not have been ready. And so, yeah, I think everybody's just looking at how can we make money last longer, and how can we actually drive things. Like, I mean, the amount of times I've heard even folks on the early stage starting talking about margins and EBITDA and things like that is just a fundamental shift. And I think what's top of mind for people, I don't think any of us have heard much on that in like the 2020 to 2022 timeframe.
If I can, I'd like to pick up, I'd like to come back to something Eugene said about sort of, well, both Eugene and Raghu were talking about bright spots and sort of the tech, maybe hard tech versus software. But before I do, your comment, Carolyn, sort of made me just want to get a sense for it, and maybe in a concrete sense, is the advice and guidance that, you know, you all are giving to your portfolio companies sort of changing? So for example, a year ago, you know, when I had some of these panels, it was, you know, we were telling our portfolio companies, you know, to make sure you have enough runway for 36 months as opposed to maybe 24 months, you know, and so we think about these things. Has that mindset started to I don't know, I'm curious. Tell me if it's, tell me the advice and guidance you're giving in this context of market.
Yeah, we've been just really quickly in terms of early stage and what we've been kind of advising on this. Yeah, we're still advising portfolio companies to take as much money as they can stomach and extend that runway out, because Series A, B investors are still a little tricky. So if we can get through this, also too, there's some of our IC members that advise that we don't do an investment if they don't have runway, if the round doesn't allow them runway over 24 months. I don't think they are happy to take their advice. I don't know if we would have that be a hard and fast rule, but it is sort of the sense that we're getting and giving to portfolio companies.
Yeah, I would just fully echo that sentiment. I think we're not totally out of the woods yet. There are a lot of new funds that have been raised, but really, you know, part of the good that I think came out of this last year is you're really getting founders who are honing in on execution, making sure they're cutting their burn rate, but also being smart about making sure they have enough in the coffers to keep going. So that advice hasn't changed. You know, it may come next year if more of these funds keep getting stood up, but for now, play it safe and make sure you have the runway to keep going.
I mean, you know, sort of last year, it seemed like, you know, there's a trend of, you know, it was very difficult for most startups to raise, but there were some that had fundamentals, and it seemed like those deals were very competitive, and those companies, you know, maybe even got to sort of feel like it was 2022, if you will. You know, got treated like it was still 2022. What are your thoughts on that? Is my sort of anecdotal observation jive with what you'd observed? And, you know, if that's true, is that sort of shifted from there?
Absolutely agree. And I think, you know, in the venture capital space, there is always that sense of the winners get all of the attention, fully oversubscribed rounds, extremely high valuations. And I think that still continued last year. I mean, we certainly had companies and investment rounds that we participated in that were oversubscribed, companies that extended the round. We spoke to investors who tried to get in on deals and couldn't because, again, you know, there was oversubscription and so on. So I think the competition for the hot deals, if you will, are definitely still strong, and I think incredibly compelling. I think it's worth noting as well that can create a different dynamic within the climate tech ecosystem. That's something that we're thinking quite a lot about, which goes back to what I think we've already had some discussion about the capital requirements for climate tech companies being so much higher, and especially for hardware companies being so much higher. You can very quickly see how there's almost a bifurcation of where that capital is going to at times, where you have companies that are successful with charismatic leaders raising extremely large rounds and receiving a lot of that capital, and other investors congregating and flocking to that because they're seen as de-risk, lower risk investments with a lot of capital for those companies and the team. Whereas other companies, I mean, to the point you were just asking, and to Shaandiin's response as well, you know, it's a much higher risk if you're looking to lead a round where there aren't already 7 other companies and funds looking to support that company. That's a higher risk investment landscape than it might have been, say, 2 to 3 years ago. So that's, I think, something we're actively thinking about, which is how can you continue to make investments in companies that we think have a lot of promise, but at more reasonable valuations than some of those extremely hot deals that you still continue to see.
And just a note to the founders out there. I think you read the news about there's like a 15 million seed round here and a 20 million Series A round there. And then when you unpack some of those, for some of those, that's really happening. for others, then you speak to someone, it's like, yeah, basically we're announcing because this amount, because there were 3 prior convertible note that kind of converted in this round. So the actual new money that we raised today is not 15 million, but it's 7. And I feel like that's something that puts a lot of pressure on founders, because they read those news and they think, wow, there's somebody out there Q4 2023 or Q1 2024 raised a 15 million Series A. And it's like, no, they raised a 7 million Series A. And yes, they raised some money beforehand. So take all your reading maybe with a little grain of salt, because it's not, everybody wants to make the bigger news. So that's one driver.
Yeah, so maybe if I can add a couple of other comments. I think there were a lot more insider-led follow-on rounds, extension rounds, quite a number of them, and maybe the other piece is a little bit of sort of flight to quality, a little bit more discipline around potentially not taking on technology risk and letting some of these non-dilutive sources of funding help with the whole retiring technology risk piece, and having the VCs kind of come in after that. So definitely seeing a little bit of that.
On the non-dilutive side, so among other things, maybe you're talking about venture debt. Maybe you're also talking about some grants as well. Shaking your head with respect to grants. Maybe we can touch on that. I am also curious to just see how your portfolios of companies have been affected by the change in the venture debt market. You know, so last year, SVB, you know, got into a real liquidity crisis, had to get bailed out. They were a huge provider of a venture debt facility, which would frequently, I'm saying this to, I know the panelists know this, but for those in the crowd, oftentimes after a company would raise a price round, in an equity round, they would sort of get to top up or get a few extra dollars either by getting a venture debt line of credit in place. And so that was seen as a way to kind of extend runway, among other things. So maybe, Raghu, since you first talked, you were actually talking about grants, but maybe you could talk about that and then segue to talk.
Yeah, so I was talking about grants, and folks like NREL and a bunch of others are way more active now, say from a few years back. On the venture debt side, I think boards have become much more not reticent, but at least they want to be a little bit more careful taking on venture debt, and the covenants have become a little onerous, let's say. So boards have become a little bit more careful in giving leeway for portfolio companies to actually take on venture debt. At least that's very clear. Even though the interest rate environment is not that helpful, and these are asset-centric, asset-heavy companies, so access is much better than a pure software play, but still careful, or wanting the portfolio companies to be careful when they take on venture debt.
Fully agreed on that side. And I think on the grant side, we've had a number of our portfolio companies that have benefited from significant funding through federal grants or government projects. And I think that's been incredibly catalytic for the industry as a whole. So as an investor, if you see a portfolio company or another company that you're looking to make an investment in that has $10 million, $20 million, $30 million that's been granted, or through a low rate loan from the Department of Energy, I think that's a really compelling signal, and also indicates that someone else has vetted the opportunity and the technology. We've also seen a lot of interest in alternative sources of non-dilutive capital. So certainly venture debt has historically been the most popular source to some degree, but we've seen a lot of interest in things like equipment financing, alternative financial structures, especially if you think about the hardware-oriented companies or the companies producing devices, looking at things like having SPVs for specific plants and projects, especially if they're not the first of a kind, but maybe a later stage project. So there's a whole ecosystem almost of alternative financing providers that are now emerging. And I think that's really exciting because especially for hard tech, climate tech oriented companies, that's something that you'll need because it's not just about expanding your user base with zero marginal cost products, but you have to be building not just the device itself, but new manufacturing plants or capabilities.
Just one more note on the grant side. From a corporate perspective, BASF is actually fairly active in working with startups to support through letters of support with grant funding for the DOE or the IUDO. So that's an opportunity where we really like to leverage the strategic benefit of our research groups and our operational facilities to help out startups that may not be at the point of investment just yet. So if there are startups out there that are working on strategic chemicals or processes that may be of interest to BASF, it's certainly worth exploring, if even too early to make a venture investment.
Well, fantastic. I think this whole panel has been sort of naturally trying to gravitate towards talking about maybe the differences between software and hardware and sort of the capital raising challenges they had. And I kept getting distracted through this panel on other sort of points and comments. So maybe we can kind of finally turn our attention to that area of focus and maybe kind of unpack a little bit of what you're seeing with respect to maybe even a divergence or a bifurcation in terms of what the paths are for these companies, and maybe whether that means sort of longer horizons, investment horizons that you have to have, or obviously we're talking about financial capitalization plans. But Eugene, I think you mentioned it a couple of times. You share with us maybe your perspective on the hardware versus software companies and what you're thinking about in investment in those and the horizons associated with it.
Sure, absolutely. Happy to start. So as a climate focused fund, we invest across both hardware and software. So we certainly have a very good number of software investments that we have made, and we think software will be part of the climate solution, but we also need hardware solutions and innovations on the hard tech side. So we invest across both sides. I think there are definitely challenges that are unique to hard tech and hardware. And I think even within hard tech and hardware, there are many different colors and variations that are worth thinking about. So I think we've mentioned a couple of times across the panel already, things like first of a kind plants. I think for those investment opportunities, I think the real challenge there is how do you scale something that's previously in a lab or incredibly small scale to something that needs to be manufacturing scale, commercial scale to be competitive with existing solutions. And so that piece about, how do you compare and how do you be competitive against your existing alternatives is really important. You can imagine, for example, how does a green steel plant compare against an existing steel plant, where steel plants cost literally billions of dollars to make without all of the innovation that needs to go alongside it. What we think a lot about is also around modularity. I think having modular systems offers the ability for hardware or hard tech oriented companies to de-risk the progress that they need to make. So you're not just going from lab scale to $1 billion or $100 million plant. There are actually steps in between you can take where you scale the impact of your technology and your customer base and the scale at which you're operating. And obviously it helps with financing as well. So you can raise increments of 5 million, 10 million, 20 million to de-risk your technology rather than just having to skip from 5 million to 100 million. So those are all pieces that we think are important. On the modularity side, it helps also because there are definitely areas of the industry where that ability to have a distributed business model is a real strength and real competitive advantage. So I think we haven't talked a lot about emerging markets, but just since there are there are participants within the show today that are from emerging markets. I think that opportunity, for example, for distributed solar to make a real impact is a totally different business model from how we think about solar opportunities, for example, at the utility scale in the US or in Europe. So those are just some considerations we think about. I think it's a combination of your technology innovation, but does that also unlock some kind of new business model innovation that you're looking at?
Ray, I see you shaking your head. Did you have some additional?
Yeah, just another point that I think, is important to help founders start to wrap their heads around is that if you're working in a capital intensive business, it requires capital to scale up, and capital is dilutive when you're taking venture capital on. And I think that's really important for folks to understand is that, if you're working on the software side and you can run a small team that's very lean, you don't need as much capital to operate, it's going to be less dilutive when you bring in equity. But I think for the really large scale capital intensive businesses, there needs to be a tolerance for a bit more dilution or a comfort level moving forward with alternate financing vehicles like first of a kind funds or debt or project financing. So I think when you're really looking at hard tech, it can really benefit a company to have board members and team members who are comfortable with debt financing and having sources to bring that on and understanding the way that affects the operational model. So I think having an understanding of how much dilution you may need to take on and alternate ways to do that than equity can really help you prepare for the future if you're working on the hard tech side rather than the software side.
If I can add a couple of strategies, right, more from a founder point of view. One is, and this is something we are seeing versus, say, the clean tech 1.0, if you will, a decade back, is how much active corporates have been at even at the early stage, and how much more sophisticated they are. I'm not pitching CVCs here, although that's not a bad thing to do. But having some of these corporate partners early on, even at the, if not the sort of seed stage, at least at the product stage, somewhere in there where you can actually work closely with some of these corporates in your supply chain or value chain to get pilots and whatnot going early on. Will help. That's a good way to de-risk a lot of things that you're already trying to work with hypotheses and stuff. The other is, and this may be controversial, so I'll throw it out there. The other is, subsidy-driven business models and sort of economics of what you're building. If subsidies are a inherent part of it, it might help to figure things around the subsidy and find ways to not be dependent on subsidies for the economics to make sense. So that's something I actually almost want the companies I'm interested in to not be dependent on subsidies, or the business model to not be dependent on subsidies. Although there are great successful companies that have been built based on subsidies, if you will.
Is that, you think, maybe a point of learning from Clean Tech 1.0, or is that also maybe a reflection of just how, and I don't want to get too deep into politics here, but sort of the political climate has been over the last few years, or is it sort of a mix of both?
I actually think it is a big learning from Clean Tech 1.0, at least these 2 points, that disruptions in like centuries old industries may not be a good thing. Meaning you want more transformative technologies and not disruptive technologies. So again, I'm in Menlo, I understand what disruption is, and maybe I'm a heretic saying this, but when you're dealing with traditional industries, to expect a new entrant to come and completely disrupt the supply chain and completely disrupt that value chain may not be a good thing. So there might be other pathways to commercialize or adoption where you take along the incumbents as opposed to completely like disrupt them. And there are some really good, interesting examples to touch on. But at least, taking the corporates along just because they are, I think, much more sophisticated now than they were at least a decade back, both on the investing side and on participating broadly into the innovation angle of it, and working with companies, startups on proof of concepts or pilots will help on both sides.
Yeah, maybe to give an example of a company we were looking at. Sorry, did I interrupt someone?
I just wanted to very quickly paraphrase. We're definitely not in the move fast and break things type industry. So don't talk to utilities or any other energy players or clean tech players about that.
Definitely, fully agreed there. I think utilities don't like breaking anything at all. But maybe to highlight with an example that we've been looking at within the green ammonia sector, we spent a lot of time, both last year and still continue to look at green ammonia as a business model. And there's a lot of tailwinds that we're hoping will come into effect with the IRA. And if you have a $3 per kilogram subsidy or support for every kilogram of hydrogen that you're producing, you can imagine that drives green ammonia to be incredibly competitive with gray ammonia solutions at the moment. But the solutions that we were looking at and the opportunities within that distributed model landscape was absolutely with the IRA, you could make a killing basically anywhere. You could be a very competitive opportunity already today across most uses of gray ammonia. But as you think about tapering off that subsidy and hopefully driving down costs with continued technology improvement, you can still see a lot of opportunity in areas that are already paying extremely high prices for ammonia because they're in hard to reach areas, because there's very high transmission or distribution costs, transportation costs associated with getting that commodity to those markets. So absolutely, subsidies can be a huge part of turbocharging and making the near-term adoption of that commodity or technology easy. But then long-term, we still absolutely look at the long-term business model and viability of that technology without the subsidy.
That makes a lot of sense. I guess you sort of one question that I sort of packed in there, which I don't think we really touched on, is just in terms of software versus hard tech. Are you all seeing sort of a difference in tolerance for investment horizon, or is it sort of still focused on the same time scale of 5 to 7 years? When for these funds, I see a few heads shaking. Shaandiin, you've been patiently waiting. I don't know if you have anything to add. No. Okay.
Well, no. I think we're software investors, and my background is mostly in the software, so I am not going to speak for like the challenges and horizons of hardware. But my sense, and it also kind of depends on where folks are in their fund cycle. Right now, we're like 40% deployed, so maybe more tolerant to longer horizons, even on the software side. But we're looking for that kind of exit conversation within 5 to 8 years, ideally. So that's, software is, I wouldn't say it's easier necessarily, but I feel like there is an expectation that it is scalable. SaaS business models are just, more easily ramped up than pairing stuff with hardware. So, I don't know. We need both. And on our side, in our thesis, I think we decided to focus on software because we've kind of seen a maturity in wind and solar and the technologies behind EVs and charging. So there's this like ripeness and readiness to have software come in, have AI and ML and generative AI now come in and to optimize and provide data and all of that for this already kind of deployed tech. So that's kind of just where our expertise is, but my sense is that there's still hopefully a longer horizon and window for hardware providers.
And maybe another way to segment this is not just hardware versus software. And I think we are, Shaandiin, Powerhouse, and us at Bluebear, we're also investing, like in our investment horizon, there is hardware development built in, because all the software that we invest in, if it's like touching wind, solar batteries, EVs, grids, everything touches hardware. I think more like our perspective at Bluebear is we have a lot of commercially ready hardware that can be built and deployed by larger organizations, and is kind of mature to be mass manufactured, and that will make a faster impact, if you will, in the next like 5 to 7 years. So we're thinking about what is the data and software layer that enables and accelerates that deployment and those operations. And I think naturally, and trying to be a little controversial here, I mean, I'm a lithium-ion battery proponent. This is what's going to help us through this decade at least. I'm glad there are folks investing in things that will get us through the next decade, because we need to be thinking of that too. But I would say, yeah, we have most of what it takes on the hardware side to get to a lot of our 2030 goals.
I think you
And I
touched on
hope
a
somebody
really
will contradict me here on this.
it won't be me, Carolin, unfortunately. But I think you touched on a good point, that the customers of the software that we all are working on are industrial customers and utilities, which have notoriously long sales cycles, which make this bucket of software very different from consumer software. And so I think a lot of folks expect demand to scale with the software itself, but really in this department, you need to be able to accept longer timelines to let that growth take off. So I think while the technology itself does scale, it takes a little bit more time to get demand from the customers in the market. So that sort of forces all of us to tolerate a little bit longer of a timeline for this industrial software sector.
No, that makes sense. So Carolin, you would basically sort of break it up maybe into, it's not hardware versus or hard tech versus software, but you would actually sort of break up hard tech into maybe, commercially available hard tech that's sort of ready to maybe be slightly optimized and sort of manufactured and scaled, versus kind of the deep tech, which is, sure, maybe proven in a lab, maybe proven sort of in not commercial use, but maybe in like a prototyping or something like that. But still with a lot of learning to go and development to go prior to it being able to be sort of manufactured and deployed at scale. Is that?
Yeah, that makes sense. And that's like to be deployed probably towards the end of the decade, or maybe even in the next decade. Is, I think we're from my perspective, that is important, and I think there's a lot of folks who are also in the audience working on things like that. There's an amazing amount of grant funding out there, from states, from the national government, from philanthropy, that can help like through those steps. I think for a lot of the venture funds, it's going to be traditional venture funds, traditionally with traditional timelines, hard to return capital in that timeline.
And I also want to just echo your point, right, which I think is a really good and astute one, which is those sales cycles for what you call, industrial software, or just, kind of any B2B software, they take longer than B2C, right? But, when you're talking about utilities and, what we've also seen is, there's a whole national security component that sometimes gets wrapped up in all of this too, as we're talking about, you know, the grid and everything else. I mean, it just, that really does push, you know, the sales cycle and timeline. So I think that's also, I mean, you brought it up, but it's just worth underscoring for the audience. So we have reached the top of the hour. It has been a fantastic panel, so much so I don't know if you can hear my sick 2-year-old crying in the background, but if you can't, that's good. I think now would be a great opportunity, maybe if we could each share maybe 30 seconds if there's anything you want to share with the audience in terms of sort of thoughts, comments, encouragement, as well as if you feel comfortable sharing your contact information. I've gotten some requests, you know, for folks who might be interested in contacting you. And maybe we'll start with Shaandiin.
Yeah. Yeah, happy to. Well, I did see actually one interesting question in the chat that I was maybe going to just touch on really quickly. Someone asked about the trouble situation in cobalt mining in Congo, and just, you know, what Carolin said about like your excitement around the lithium ion future. We've taken a almost a 2-year deep dive into the kind of advanced mining exploration for transition mineral space. So basically this climate tech gold rush for cobalt, lithium, copper, and other transition minerals. So just want to maybe thematically, we've just been really thinking about how do we as climate tech investors engage in a highly extractive industry that we all need to get off our high horses and understand that mining and the raw material space is critical for everything that we're talking about for our transmission lines and EVs and wind and solar panels and all of that stuff. So I just thought that was a timely question. And in terms of the supply and demand gap that is growing in the space, which makes it a really interesting opportunity for investors to understand mining efficiency. How do we drill more or predict where to drill next more accurately? So you're not disrupting, you're not, you know, hopefully doing it more efficiently, ethically, sustainably, which is all pressures that mines are faced with right now. So I just wanted to touch on that really quickly since it's an area that we are digging in deeply into. But in terms of, I don't know, stuff that I'd leave with the audience, I think for all of the founders out there, if you're going out for your first kind of institutional raise, just really hardcore focus on what makes a complementary team. You know, who are the networks and expertise? Do you have skill gaps there? We always kind of look for that. And I don't know, other investors might feel differently, but we rarely invest in sole founders. So who can you scope out for your founder dating a cycle and really build a strong team? And then the last thing I'll say is on the founder side is just a reminder that no is only a no right now. It can also become a yes later. And we're actually gave a verbal recently to a company that we said no to 3 times. So just a reminder on to relationship build there. And then just for the audience generally, you were talking about time horizons and stuff that'll come to fruition at the end of the decade and beyond. And maybe just like a collective reminder that we are in this climate window, this climate decade right now, and we have like almost less than 6 years, 5 years to that window. So just an invitation for all of us in the audience to just be as bold as we can, push the envelope, and then get to the place where we don't need those like the tech that's going to save us, that's going to be deployed in like 15 years or 20 years. So invitation there to be bold.
Thank you. And I'm sorry, was there contact in LinkedIn, or is there any contact information? Is the best way?
Yeah.
Or your fund. I don't know if there's an email address at your fund.
I think the best way, actually, I'm really responsive on LinkedIn, so I'll just chat my LinkedIn link in the chat. And also, I'll also post our research on the mining side as well.
I think you just posted this to just the host and the panelists.
Okay,
check
I will
that.
figure out how to do this.
Everyone box.
Okay,
Yeah.
I will figure that out and repost it. Thanks.
Thanks for keeping us on track, Carolyn. By checking the chat. As I said, I don't check the chat. I'm past saturated as is. But do you have anything that you'd like to share, Carolyn?
I just shared a link from our friends at Elemental Accelerator. That's like one of the accelerator groups. They actually have calls for startups open right now till the end of the month. I think it's a really good program. I think for you, as if you're a founder out there, find a good group that you like, a startup accelerator incubator group that you like. And I'm not suggesting participate in all and everyone, but pick one. I think that can really help accelerate your journey. So Elemental is one idea. There are many more out there that you can look out for, and even like just locally. For example, Plug and Play and Techstars, they're really active also in the climate space, and they have across the globe local hubs where you can be part of, because the journey can become lonely, and it's easier if you have a group of like-minded people around you. I can only echo what Shaandiin was saying around team and finding team members actually from the industry. I would look at, I mean, we saw the recent layoffs, for example, at Tesla in the EV charging space. Is like things like that can play to your advantage as a startup founder. There might be really good talent out there that you can tap into and just bring on board. I'm also shared my LinkedIn here, which is just Carolin Funk on LinkedIn, for you to contact me.
Terrific. Eugene?
Sure. So contact details, firstly, I think my LinkedIn is pretty easy to find. And then on Clean Energy Ventures website, we have open application for companies that may be a fit for our investment thesis. So, there's no sort of gating criteria. You're welcome to apply if you think you'll be a fit for our investment thesis. So that's www.cleanenergyventures.com. In regards to what would I say to founders within the space, I think we've been a bit doom and gloomy about climate tech and funding and technologies and how capital intensive and so on, and challenging it is to sell to energy industry participants. But I think there's been no better time to be working in climate tech than now. And I say this having worked in the climate tech space for 10 years, and halfway through, went back into consulting because there weren't exciting opportunities that I could see within the climate tech space that were compelling. So I think, even despite all the talk about Clean Tech 1.0 versus Clean Tech 2.0, I think there's been unprecedented capital available, talent available, problems and opportunities, corporates that are engaged to work in climate tech. So certainly encourage everyone who's interested in the space to keep going forward. It's really genuinely a good time.
Wonderful. And Raghu?
Yeah, I'll leave my email, LinkedIn, and all that on the chat. But yeah, I mean, just to reflect everybody else's comments, this is a great. It's almost like a calling. I understand being a founder is it takes a different type of individual. So kudos to everybody that's stepping up. But I guess what came up in this discussion, right? Be aware of non-dilutive sources of funding early on, and there are some very interesting, not just accelerators, like Carolin mentioned, Elemental, Jules Accelerator. There's like a number of these that are doing a phenomenal job, but also agencies like NREL and EPRI and all these are providing very interesting pathways in which you can de-risk technology, get something up and running, get quick feedback, and do everything that you need to do anyway at that early stage to de-risk. And then, of course, I always plug corporates and ask you to work with corporates early on, because they are leaning in, and there is definitely a mandate to bring and work with new innovation. So, and then maybe the last thing that might be of interest is just as you're breaking your head with product market fit, you might want to also consider startup VC fit, especially in this space, because it's not like, you know, enterprise software. So you might want to be a little not picky or choosy, but at least spend the time in understanding who those key investors are who can actually be part of the journey early on.
That's very sound advice. And it echoes, I think, what Eugene was saying in terms of, you know, you want to make sure you know what the fund's thesis is and theses, and make sure you're in line with it. Ray, haven't forgotten about you. Any words of wisdom?
I think everyone covered it fairly well. Would just echo the idea that fundraising is a long process, and it should be that way. We really like to get to know a founder before we make an investment, and feel it. The founder should feel that way about us. So like Raghu said, it's important to know who you're bringing in, who people are going to sit on your board and support you the rest of the way. So really just advise founders to be thoughtful on that. Don't be afraid to work with corporates. We can bring a lot of expertise and support in to help your company with scale up and market access. And when you're putting a team together, just really focus on a team that knows your customer so that you know the problems. And that's the best way to really bring a good solution to market. So really appreciate you having us all today. And yeah, looking forward to questions.
Sorry, I forgot to take myself off mute. First time that happened today, so it's not too bad. I'm sorry, best way, LinkedIn or yeah.
Yeah, LinkedIn is great. Just Ray Abbiatici on LinkedIn. I can see a number of you have found me already. I'll post my link in the chat as well.
All right. So shifting to some questions, I think, you know, we actually kind of mentioned, or this came up in the topic of conversation, sort of what are kind of current deal terms looking like for these companies. And I think it came up in the context of, you know, in 2023, there was a lot of bridge rounds. I mean, I feel like it was sort of the year of the bridge rounds, and maybe even the year of the sort of inside-led rounds. Inside-led round being, you know, you have already have investors many times on the board, and those folks, you know, there's difficulty finding sort of outside capital coming in, so they're putting in some additional funds. I kind of think that's shifting, in, you know, from Q1, but what all are you seeing kind of in the market, and you know, in terms of that and valuations, etc.?
I think it really depends on the business fundamentals. If you raised a round in 2022 and actually met your goals and actually shown like 100+% year-over-year growth, you will be rewarded for that. If things haven't been going that way and you haven't met your goals, then I think folks are out there to kind of bring things probably back to where things would have been in 2019 in that market. I mean, not like lowering all the way to that, but really kind of rectifying some of those terms. And I think what we're seeing a lot is like insider-led rounds, or folks who are coming in and trying to figure out how to get their target without getting to a down round. And so be prepared to talk to folks like Jason, who know a lot about what all these kind of liquidation preferences, warrant structured, what types of warrants, what other mechanisms there are that people are getting into your cap table actually mean before diving deep and signing anything. Don't ask ChatGPT, because they might make stuff up. So a plug-in for the lawyers here.
You're too kind. I mean, I'd have to sort of on a related note, you touched on fundamentals, and there's a question in here sort of about fundamentals. Now, this question is sort of focused maybe on what a deep tech play would be and kind of how that maybe gets measured. But, you know, is it possible for the panel at least maybe talk about in broad strokes what, you know, maybe even kind of talking about on two ends of a spectrum, kind of what a sort of software play might look like in terms of fundamentals for a early stage company versus what you think about if it were a much more sort of deep tech play?
Eugene has both sides of that.
I'm happy to start. One of the things we've been seeing as we look across the landscape is that there are just so many variations of investors. Each have their own metrics and criteria. Some will say it's growth stage if you have a minimum in 5 million in revenue. Some will call it 1 million. Some will call it 10 million. So really, I think the metrics, as you say, vary across investors, and I think investors just decide on their risk appetite and invest there. For us, and happy to speak at least for how we think about making investments in hardware space, we think about the technology risk. So I think especially if you're investing in hardware and hard tech and someone's making a really meaningful innovation within a particular technology space, more likely than not, they're coming out of a PhD program, a PhD lab, and they're really at that pretty early scale, early stage size. What we look for is whether or not that technology has been sufficiently de-risked such that it's not an R&D project. It's not, is this possible? And what's the catalyst that's required? What's the different pieces that are required? But how do we scale this up? So we have all of our core pieces that are required for that technology. How do we scale up that capability? On the software side, I mean, we've got plenty of software investments as well, investors around the table. We will similarly invest in companies that are pre-revenue, but I think it's perhaps a little easier to be closer to your first sale and to your first customer if you're building a software product, just because of the time to market.
Yeah, I think that's great. I don't know if anyone else has anything to add to that, and if not, there's a question which I think is of very general applicability, especially because I think 50% of the folks here or who are attending are early stage. Maybe this is their first raise, but as they're kind of putting together a pitch deck, when you all are looking at a pitch deck, how, I guess, zoomed in or detailed, are you looking, or kind of is appropriate in your minds to be thinking about that exit, and like how emphasized sort of is that, given that so many of these companies will inevitably pivot or face some change to whatever that anticipated business model is? So how detailed should it be, and kind of how much weight do you give it?
I mean, I think if you're sending me a short intro deck, first time I see something about your company, I want to know your big vision, and I want to know how you get started on that big vision. You don't have to share with me like who are the exit comps and what you think are going to be multiples. You can leave that to us. We probably have done more work around that. But what I've seen a lot recently, and guilty myself, it's like just having a lot of the conversation initially being about what is the first step that you're taking, and the second and a third step, and almost like I've been trying to make more of an effort at the first introductory call to take at least a few minutes at the end to talk about the big vision, like where can this go from here, because I think we need your big vision to pitch that to our investment committees, and you can make it a lot easier if you provide that to us. I don't necessarily at this point think about the exit or end game, but it's more like the big picture is like, where can this go? Like the moonshot, and I think every founder should have that in mind, and remind folks like us that, hey, by the way, I'm talking about the kind of operationally step 1, 2, and 3 here, but here's a slide on my big vision.
Yeah, and I think sometimes that big vision kind of gets lost in the market sizing slide. And so I've seen a couple of good decks that kind of pair market sizing with like showing this long-term vision of like, how do the customers change and how does the business model evolve? And But don't let that get lost. Don't just think you can just slap it into the market sizing page and just be done with it. I agree. I want to have clarity to pitch to my team for the next stage that, this is the bigger moonshot vision and get people excited about it. So fodder for me to help tell that story is super helpful. But yeah, I would agree. Like, I don't need to see like exactly who your exit pathways are at that point. We definitely ask about it. Like after the first initial calls when the team's like on board to learn more and get into early stage diligence. But I would just recommend, like, for pre-seed investors, a lot of them are like, I don't know, I'm literally so early in this. Why would I think about the exit pathways? And I think it's just showing that you can be really thoughtful and strategic about what that looks like. We do need to hear something. We're either going to do our own research and tell you what your exit pathways are, or you can help us guide and be strategic around that. So I would have a thoughtful answer around that at some point.
I think that's really important, especially for us where we invest a little bit later. It's a Series A or Series B. It's really important that at least if you're going to start having a conversation with investors about exits, that they are anchored in reality of comparable transactions and not just some multiple that you may have read about in a recent article. So, for instance, if you're coming to say that, we're going to be acquired by a chemicals major in the next 5 years for $2 billion, but you look that no chemicals major has made a $2 billion acquisition in the last 10 or 15 years, then that's going to raise questions. So just make sure if you do come to the table with a conversation about exits that you've been thoughtful, you've studied the market a bit, and aren't just looking at multiples on your projected revenue.
And you can turn it also around. If you've talked to multiple investors and some of them have kind of gotten down the road a little bit with you, or you have existing on your investors on your cap table and you're looking to raise the next round, it's like, ask them. It's like, what were the exit comps that you looked at while you were underwriting the investment? Or how should we think about it? I mean, it's not like you have to come up with everything on your own. We're doing a lot of work behind the scenes. Rarely folks ask for some of that. And yeah, some stuff we won't share, but other things we might be happily sharing. So it's always worth asking before putting in your own work.
So, I mean, would it be sort of fair to summarize it in terms of, kind of early stage, maybe C plus or minus? The founder needs to be able to articulate a vision that is sort of big enough and grand enough that one could see the exit multiples, if that were to go that way, would kind of work out, but doesn't necessarily need to know the nuts and bolts of kind of what that exit is going to look like. Although if they open the door into what it's going to look like, they better be able to, articulate in a reasonable, rational way why they feel that way. And then sort of show maybe the milestones and steps back in time from there, with them having more concrete plans, for that sort of first step or two, so that kind of people understand how this capital is going to get deployed and why it would make sense to do it. Is that a decent summary of, okay. Well, that's great. There was another question I had in terms of, well, that's kind of a funny question. Earlier, we were talking, this is maybe a little bit of a play off of the question about whether or not climate events should be green, and we're virtual, so it's fantastic. We've got folks from all over the country. And Raghu, I'm sorry, are you in the UK right now, or where are you located?
I'm in Menlo.
Oh, you're in Menlo. Okay. But we've got folks from Denver and obviously folks from the Bay Area and LA. So give some credit there. Earlier in our pre-conversation, we sort of talked about maybe the shift in getting to know founders, and there's sort of less time spent on planes and to build rapport. Does any of that sort of pandemic, post-pandemic sort of shift and comfortable there, everyone's sort of level of comfort with virtual, does that sort of play into how you continue to interview and determine whether or not founders are sort of appropriate? And do you kind of take also a sort of carbon cost assessment in sort of viewing, are we going to go fly and see these people, or are we going to bring them out, sort of, et cetera?
I'm happy to start. So, I mean, obviously everything changed significantly during the pandemic. I think we still have the view that, whilst we try and reduce our unnecessary air travel as much as possible, ultimately early stage investments and building a company is incredibly hard, and that personal connection is really quite critical. So to the extent, it makes sense. I think, meeting people and seeing each other face to face is still part of our investment criteria and process. I think perhaps what has changed for us and other investors as well is the stage at which that happens. So whereas I think, you hear a lot about people flying to Silicon Valley to meet with a VC for a first time meeting, and that was kind of like the first step in the door and the minimum requirement. I think increasingly almost all the first calls I have with companies are via Zoom, even if, frankly, they live in the area or where, a few miles from each other. It's just easier, quicker, and I think more time efficient on all sides. But if we are moving to a stage where we are serious about the investment, late stage diligence, and about to execute, then meeting each other and having a meal, a coffee, whatever it is, a presentation face to face, and seeing the labs for us as well as a hard tech investor is really quite critical. So definitely still part of our investment process.
I'd say we're very much the same. We invest in both software and hard tech, but getting that site visit on a hard tech investment is absolutely critical. And we really want to get to know the team beyond just the founder and CEO. So I think that's a much easier thing to do when everybody's in their comfortable environment, better understand the way that teams work together. That's super important to our diligence process. So, certainly agree. We're able to hear a lot more pitches now that things are virtual. But I also think industry events are great for that, where they sort of operate as a speed dating opportunity, where you meet as many founders as you can very quickly. And I think you get a lot more out of that than purely virtual. So good comes out of both, but you can't discount how important those in-person interactions are.
Fantastic. We've reached about 1:30 Pacific time, and I think it's time for us to break. But it's been a fantastic panel. I want to thank you, Carolin, Raghu, Ray, Shaandiin, and Eugene. I want to thank the audience members for attending, whether they're live or on a time-shifted basis. Rob Lau and Idea to IPO for organizing today's event. And I also want to thank my firm for enabling us to have this conversation today. It was wonderful. All right, I'll let you guys get back to your board meetings and other important obligations, and those who are building their companies to get back to their companies. So take care. Have a good afternoon.
Thank you, guys.
Great, thank you
Thank
all.
you.
Thanks, everyone.
Bye.